If you have been following the US Treasury market lately, you will notice that the Treasury yield curve now looks like this, a bit like a slanted Nike logo. Under normal circumstances, the Treasury yield curve should be a simple rising curve. Because you see, the longer you hold a bond, the greater uncertainties you're going to face. Therefore, you're going to demand a higher level of yield as compensation. This is the same case as how futures prices behave normally. The further out the delivery date of the futures contracts, the greater the uncertainty and storage costs as well. So a normal futures price curve is also an upward sloping contango. So why does the US Treasury yield curve look like this now? We can understand it from three perspectives. First, the leftmost part of this curve is the easiest to understand. You can think of it as the end of a rope fixed to a wall. It's strictly controlled by the Federal Reserve policies. The Fed has various policy tools to keep it near the effective federal funds rate. Then comes the sharp drop in the 2-year yield, which is also not difficult to comprehend. Over the past 2 years, to fight post-COVID inflation caused by supply chain disruptions and excessive money printing, the Fed pushed the benchmark rate about 5%. This is clearly unsustainable. Now that inflation has been suppressed, the Fed must start cutting rates, and the 2-year Treasury notes are the most sensitive to rate changes. As investors expect the Fed to cut rates more rapidly and significantly over the next year or two, the yield dropped sharply at this point. But starting from the 2-year mark, the yield curve begins to rise steeply. The first driver of this is the long-term inflation expectations. The market believes the US government's current debt level is getting out of control. And to sustain the deficit, the Treasury must continue to issue new debt, and more money will be printed. Naturally, long-term inflation expectations will continue to rise. Furthermore, long-term yields are driven by a higher term premium. Well, this premium is just like the money you pay for insurance policies to hedge against the term risk. So what is term risk? For example, if a close friend of yours borrows money from you and promises to pay it back next month, you might just lend him the money and ask for nothing. If they say they're going to pay you back in a year, you're probably going to ask him for some interest. If they say they won't pay you back until 10 years later, then you will start to worry about not getting the money back at all. Of course, when the US government borrows, default isn't a concern. But even for 20 or 30-year treasuries, creditors still demand higher yields as compensation. This is the extra yield related to the term. So the term premium is essentially the insurance price to hedge against the risk from longer holding periods. In the past 30 years of steady globalization, everyone focused on making money and nobody asked questions about Taiwan or democracy. The global economic environment was stable. So investors felt relatively safe even for holding 20 or 30-year bonds. But today, decoupling, tariff, energy transitions, and geopolitical conflicts all have brought massive uncertainties. And no one can say what the world will be like in 20 or 30 years. So this insurance premium is just getting more expensive. Then finally, a rising neutral rate also pushes up long-term yields. What is a neutral rate? You can understand it in two ways. It refers to the interest rate where monetary policy neither stimulates economy, leading to overheating and inflation, nor does it restrict the economy, leading to recession and unemployment. At the neutral rate, inflation generally stays stable, like 2%, while the labor market reaches an ideal state of full employment. The neutral rate varies by country. For instance, India has a very healthy demographic structure, with a high proportion of young people, which supports a higher neutral rate. While Japan's demographic landscape is much more aged, so its neutral rate is lower. In some Southeast Asian countries, many young men will become monks for months or years. This can suppress the neutral rate. Some countries have a very aggressively mercantilist culture, and practically no religion at all, where everyone wakes up thinking about how to make more money. Their neutral rates will be higher. So neutral rate is just like how vibrant a man is. The younger, healthier you are, the higher the neutral rate. For the US, the economists agree that the current neutral rate is around 1%. Japan and Europe are more likely to be below that level. According to Robert Solow, the Nobel laureate in economics, active in the last century, continuous economic growth will eventually lead to a steady state. This steady state basically corresponds to the economy at a neutral rate. And to break that steady state and boost growth again, the only way is exogenous technological progress. So can you recall any examples of technological progress breaking the steady state in the last 20 or 30 years? I would say that the internet serves as a perfect example at the turn of the 21st century. The internet increased the speed of exchange of information and consequently breaking the previous steady state, allowing the global economy to grow at a faster pace for 20 more years. If today's AI is equivalent to the internet 20 years ago, what's going to happen? You might say AI just helps me make PowerPoint slides faster, or write reports faster. But think about that. Doesn't that save time mean that you can handle more other tasks? Isn't that increased productivity? The conclusion of Solow's model is that the long-term level of interest rate depends on the overall productivity level. So if AI can really pan out like the internet 20 years ago, or the steam engine in the 18th century, increasing the US potential growth from 1% to 2% or even 3%, then the neutral rate will also rise, and pushing higher the long end of the yield curve.